Welcome guys, welcome to this new series with ICICI Direct, Mutual Funds की बात ICICI Direct के साथ. Today we have Mr. Swaroop Mohanty with us. Mr. Swaroop Mohanty is the CEO and Director of Mirae Assets. More than 28 years of experience in this field and a veteran of this field. So it's an absolute honor to host you, Mr. Mohanty. How are you doing?
I'm doing good. On behalf of Mirae, I'd really like to thank you guys for hosting me. I'm looking forward to this conversation.
So Swaroop, I have my colleague Mr. Abhishek Murarka with us. He is the lead for social media with ICICI Direct. So welcome Abhishek. Can we start with you with this question?
Yeah, sure. Welcome, sir. Pleasure to host you. So I was thinking, sir, I was just looking, a lot of interesting new developments have happened at Mirae. One important is I saw you cross 10,000 crores of AUM in your mid-cap fund, which I think is a very, very important feat. And something which also is, I think, interesting is you opened an office in Bhubaneshwar. And I think you have a connect with Odisha and Bhubaneswar, a strong one. So how is that feeling? And could you talk a bit about that?
Yeah, whenever you talk about Bhubaneshwar, it brings a wide smile on my face, right? I'm born, brought up, and educated in Bhubaneshwar. I'm son to two professors there. My mother retired as the principal of BJP College, which is the premier college there. And my father retired as the principal of Rajdhani College there, which is also a very large college in Bhubaneswar. So son to two teachers can be very different to the line that I'm doing. They teach zoology and I'm a mutual fund guy. So the bringing and the career have been contrasting to theirs. So I've had my issues or share of debates with them. But here I am sitting in front of you. But opening the office in Bhubaneswar always special. I've been dealing with Bhubaneswar professionally from the 90s. So going back there always brings fond memories. Yeah. And 10,000 crores in mid-cap, I must say, is a factor of the track record of the fund. And extremely thankful to all our partners and investors for the trust they've shown in that fund.
So just one thought. So you have had a very long journey, and very interesting when you said your parents are in very different space. They are educators, they are teachers. And I think mutual fund also involves a lot of education. And this industry has seen such an interesting cycle. Like, can you just explain how you see things have changed in the last, say, 5 years to a decade?
No, Abhishek, I think, when we look at change, let's look at the most significant recent change that has happened in our lives, and that's COVID. I mean, I say this all the time because I firmly believe in it, is that there used to be before Christ and after Christ. Now it is before COVID and after COVID. The impact that COVID has made to each one of our lives, whether we had COVID or not, is irrespective. 2 years sitting in our houses alone, scared for life, has changed us permanently mentally. And what's come out of COVID is very significant from a financial asset perspective. I'll give you a small data point. Before COVID, so the industry was, say, 25 years old, we had 2.23 crore unique folios, total mutual fund industry. Post-COVID, first year, we added 1 crore. That means 50% of what we had added in 25 years got added in 1 year. Now we are adding 70 lakhs on an average per year. So the shift from fixed asset investing to financial asset investing is real now. And that's the significant change. People have been able to, first differentiate between what is a need and a want in their lives, and have been able to restructure their financial or income statement and then come out with the basic desire, apart from leading their lives to the fullest, also the need for investing has grown. So that augurs well for not only the individuals, but also for us as an industry.
Wow, that's a phenomenal thought. And actually, I've seen people have, COVID has been great for people. People have realized a lot about themselves. They didn't think, they got time to think. And so you mentioned that probably people realized the need to be in financial asset. Do you think even the digital ecosystem came up stronger, which created more awareness about the need to invest in that times?
I think you said something very, very important, because it's not about just people realizing. I mean, let's look at lives before COVID. And Abhishek, please relate to what I'm saying. We were mostly a very desktop, very few laptop regime. COVID converted everybody of us to laptops, right? Now, bringing a laptop is not the big deal. But when you get a laptop, every individual laptop has to be given a VPN. right? You had to
Yes.
outsource your basic internet connection to everybody's houses. And gone are those days when we have that, proverbial buffering in our system.
True.
The number of instruments or machines on the internet have, quadrupled or 10 times or 100 times, I do not know. But the internet facility has also gone up. The speeds have also gone up. The connectivity have also gone up. In that short time, the hardware companies were also able to give us the number of machines that we needed in a closed environment, right? And the tech upgrade that has happened in India specifically has been a treat to watch. Look at the payment system, to the way we now interact with each other is just such a different world in the last 4 years. So it's just not, the thought of the people, but the environment around us has also aligned itself, whether you buy a car to whether you use your basic utility or buy vegetables. The tech part of our lives is something which we cannot ignore. And think of this just before COVID and think of it now. The change has been significant and pretty dramatic when you think of it.
No, that's very interesting. Actually, that brings to me a quote which says ki every major event brings a change. So I think COVID will always be remembered for being that, I would say, inflection point for many things in life.
True. Absolutely.
Apart from the calamity and people who there were negative effects, but it brought a lot of progress.
Look at the medical insurance sales post-COVID. When it should not have needed a COVID to give birth to this thought, it should have been there already. But the medical insurance sales post-COVID are in a different trajectory, right?
True. No, that's interesting. Gaurav, you want to take over? I think Gaurav.
Yeah, I'm there. So I'm saying Mirae just completed, Swaroop, so Mirae just completed 15 years in the industry. So could you just tell us a bit more of the AMC offering that we have for the investors, so that the investors listening to this podcast will have much more clarity with the AMC offering at Mirae?
I think 15 years was something which we had dreamt of when we started. And the thought was very simple, was to stick to the core of the business, and the core of the business is asset management. So we wanted to be known through our products. So the first 5-10 years we spent in building good track record for our core products. But we looked at COVID at a very different way, and that's when we had built some track record for our main flagship products, which is the Mirae Asset Large Cap as we speak, and Mirae Asset Emerging Blue Chip. The consumption has also built some track record. The debt bouquet was also building some track record. But we took COVID as that period to expand our product basket. And today, as I stand in front of you at 15 years of track record in India, I can very well say that we look a far more diversified asset manager than we were before COVID. We have products in both the core and satellite part of any investor's portfolio. We have products in all asset classes, whether it's equity, debt, hybrid, or say international. We have products both in active as well as passive. At our end, we believe that we will build strong products, and that is our job. We are agnostic to whether it's an active product or a passive product. On the active side, we sit in front of you saying that we aspire to give you alpha. On the passive side, we aspire to give you a very well-constructed index mimicking product with low tracking error. And since we bring our own liquidity to the market, it should be liquid enough. Now, when it comes to construction of the portfolio construction happens at your end or at the investor's end. And then when you look at us as a product basket, you should get enough products from our side. Having said that, we play to our strengths. We believe in only getting products which we can deliver. So still there are a lot of areas where we do not have products yet. So when we build strengths in those areas, we will bring those products. The simple point I'm making is it's been a interesting journey for products in our basket, and we really back ourselves in creating good track record for all our products. Now, please understand, Gaurav, is that in India, in the last 15 years, we stand in front of you as the only organic global AMC in the market. There is no other organic AMC in the market. That's how, tough this market has been. But our ability to stand firm and back our products and believe that one day this industry will shift from what is a good brand to what is a good product is beginning to play out, because now we believe we build a good platform for ourselves. With 57 lakh folios at our end, we are a fairly diversified and retail penetrated AMC also.
I had this question to ask you later, but since you mentioned the only organic MNC player to scale in the asset management space, and so I track this space. Like I have interest in financial market, and I have seen even on the banking side, some of the most prominent names have struggled to scale beyond a point. So what did Mirae do different in understanding the psyche and the needs of the Indian consumer to do what you have done? Like, what did Mirae do different? If you could answer.
I don't think Mirae did anything different. I mean, it stuns me. Let me tell you, even today, and I give an instance of last week when I was in Seoul and I had the fortune of hearing the global view of our founder and chairman, Mr. Hyunju Park. The absolute conviction that the organization has on India is unbelievable. They in verbatim, they said the only country to invest right now, and this is our house view, and global house view, is India. You know, and when you have that kind of a conviction from your promoter, it's a very different ballgame altogether. It's a business of simplicity and continuity. If you have conviction in that process and you are willing to sit and wait for your term, at the same time, build good track record for your products, a lot can happen. And that's exactly what we did. We didn't take any shortcuts. We kept our, even today, our product basket is very simple. We cater only to our strengths, like we said. And if you look at our journey, or typically, AMCs are tracked by their AUMs. If you see our AUMs from 2008 to 2016, or for that matter, 17, 18, there was hardly anything to write home about. You see our AUM before COVID was just 40,000 crores. Today it is around 1,30,000 crores. So things change when you build track record, and that is the conviction we had. Yes, you had to build good track record, was a given. I mean, that's something which we backed ourselves, and that's something which we are in the continuous process of putting on the table. At times of underperformance, we are absolutely cognizant of that fact, and we go back to our drawing boards to work harder to bring it back to the table. So there have been some periods of underperformance, but I think the people who are more cognizant of the fact have been ourselves. We have just one rule when we do this business, and what is right for the investor is right for us, and we follow that to the hilt. Keep your business simple, and that simplicity, if you can continue over a period of time, why, Mirae, any business will be successful.
Absolutely. Well said, Sarup. Sarup, I have this question with regards to someone who's wanting to get into the market right now. Since we are at all-time high, and if as we speak, probably we may hit all-time high now because Nifty is at 18,875. Mid-cap index is up, and small-cap index is around 18% away from its January high. So someone who wants to get into the market now, how should he plan his allocation and all those stuff? So can you just throw some light there?
See, first of all, anybody who is coming into the market has the great advantage of having a smartphone today, which say I didn't have when I was young and I started market. The point I'm making is the information is there for you, right? You can Google a lot of things at your fingertips. Now, a simple fact is 99% of investors, watch the market. The 1% which does not watch the market makes money, right? You can only control your controllables, and the controllable that you have is what you do with yourself, your own behavior. And a lot of that behavior is reflected through your risk profile, through your asset allocation. First question to ask yourself is a very simple but powerful word: why? Why do you want to invest, right? Set your goal for investment. If you make your investment a tangible journey, there will be some meaning to it, right? If some people say we want to create wealth, fine, define that wealth. Some people say that we want best returns, fine, define that returns. If you say you want this much of return, then you can have a portfolio according to that return. right? No, everything that you do, you don't go into buying a house saying, "Dekhte hain, 4 bedroom milega, 6 bedroom milega, jo milega le lunga." Doesn't happen like you plan everything in your life, but when it comes to investing, and that's where our job becomes a little tougher from here on, or becomes more intense, is you have to educate people on the most important part of their investing journey is their portfolio, which is their asset allocation. Now, everybody's life is different. Abhishek and Gaurav, your lives are very different because of your ages, your wants, your needs from mine. So hence, my goal will be extremely different or will be totally different from yours. Nothing right, nothing wrong. Now, once I fix my goal and I know why I will invest, where to invest is a very easy part. Right? So the first question that I'll ask every investor to do is to spend some time with yourself, maybe shut yourself down in a room and just jot down what you want from your investments. Once you know that, then rest, there are enough qualified distributors in the market who can help you. If you want to back yourself, there is enough on Google to help you. But this is the most important part. After that comes everything. The goal setting is something which is missed mostly. And I'd like to leave it at that, saying that concentrate on goal setting. Rest is not the bigger issue. While 99% make the rest a bigger issue, hence their investment journey is not what they desire to be. It has been an observation over the last, 25, 28 years of being in this market.
Absolutely. That's the main important thing. You need to have a goal, focus on that goal and work towards that goal. That would
see, if I have a goal which needs 10 lakhs and there is 10 lakhs in the market, in my bank, I just need to aim at beating the inflation with that 10 marks. Yes, the other part which one embarks on, the second rule which once you set the goal, the second rule which one must have or objective is all your money should beat inflation. Once you have clarity on these two, rest becomes easy.
Just thought on that. So practically what happens is when people set a goal and when they start progressing towards that, the goalpost keeps shifting because life is not linear. Life is a sum of uncertainties, right? So that is the interesting part. If suddenly something good happens in my life, then I don't want a desire. I would want a German-made car. So that's very interesting why people always deviate from the strategy. Probably a dynamic goal setting is something that you can think of.
No, Abhishek, nothing wrong with that. As you progress in your life, when I started my life, I didn't think that my earnings will be this.
Yes.
Right. But you have to be cognizant of the change in your desire.
Yes.
Once you write down your goal and you deviate in your goal, you should also put that as a clause. Right? That you started, like you said, you wanted a desire, nothing wrong in wanting a desire. Now you want a German car, nothing wrong with that desire, nothing with that want. But then accordingly, your plan changes. True. Right? 9 out of 10 people don't realize that it's their lifetime change which is hitting their portfolio. They blame markets for it. But it's the increase in lifetime desires which change their portfolios. But as long as you write them down and incorporate that in your plan, nothing wrong with it. You set out your life to desire certain things. So you should back your desires. I'm for backing one's own self for fulfilling one's desires.
Great point, sir. Sir, I just wanted to highlight something. I saw a recent tweet wherein a very interesting one. You said to sit in the market and benefit from the full potential of a growing economy like India is rarely understood and practiced. You also mentioned that Mirae house view is very, very strong in India. Could you just speak a bit about why are you so bullish on the India story? There are many moving parts, but if somebody, suppose an FI is sitting, looking at India, what should they know for the next 10 years?
See, first of all, I think I'm so happy that you asked me this question because many of us realize this in the subconscious. All of us know that India is growing, but what's staggering for India is if you look at, again, going back to the check post of COVID, India was practically slowing down before COVID. Go and check data, but post data, something has happened in India. It's like a rebirth. And then for the first time when we give data points and you look at data points, whether it's from four-wheeler consumption to tax collection to power consumption to medical insurance consumption to energy consumption, to power consumption, to building roads, to building airports. I can just go on. The data points are just adding up year on year. The simple point I'm making is India is no longer just one or two sector story. It is beginning to look like a broad-based sector story. Our house view earlier, the Indian house view was India can only sustain that much if it caters only to service industry. Manufacturing has to start. And thanks to PLI, we are seeing green shoots of manufacturing now beginning to start. Now see, manufacturing is a 10-year story. It can't just happen that somebody starts a plant and starts making money tomorrow. But say a large company like Apple now deciding to manufacture in India, and Mercedes bringing out its full-fledged EV from the Pune branch, are just offshoots of something which can only grow from here. So the manufacturing start had got added, again adding to the broad-basedness of this story. Now you can't take away 2-3 things about India. The demography plays consistently to its advantage. 60% of world population under 30 is in India. That is very, very impactful when you look at the type of labor India can give. And then please understand, Indians are educated labor. To the world is not a joke anymore. It is the cheapest labor available in the world. We are cheaper than the Vietnamese and the Philippines now. Do the labor study, and it's there. The data is there for you. Third part, for doing business, the corporate law is now in sync with the world, probably cheaper than a lot of countries, right? When you add all this up, it is a structural story at a time when the world is actually slowing down. China has slowed down. If you look at the last 1-2 years of global growth, it's the Indian growth which is adding to the global growth. This was not happening, say, 10 years ago. And I'm not giving a political story here at all. This is a data-based story. This country is going from 3.5 trillion to 6.5 trillion in the next 8-10 years. Now, when you know that 3.5 trillion will go to 6.5 trillion, one of the best ways an individual investor like me can benefit from this story is through the capital markets. Now, 3.5 trillion will go to 6.5 trillion. I will only enjoy if I sit in the market. Now, I will try to predict the best 15 days of that journey is impossible to do. Just by sitting in the market, you make money. That's true, no? I mean, a cricket analogy we were taught when in younger days, you stand at the wicket, runs will come.
True.
Right? You bowl on the wicket, the batsman will make a mistake. It's like that. You have to sit in the market and enjoy the ride. India right now probably, as the markets become more and more transparent, the chances of alpha, which is written over markets, also start diminishing. This is probably the last decade of some significant alpha there. And then people who stay outside the market will not benefit, or people who try to time the market. I mean, look at the last 1 year. 1 year returns have been there, but if you look at the industry data, industry has been redeeming. Nothing wrong, nothing right, it's their money. But people at an all-time high also, when you look at the next 10 years, maybe in the near term, Gaurav, to answer your question, it looks a little expensive. But once this whole thing of COVID impact and the oil finally looks to be under control, or this war impact goes down and the data points of the world come out in a very unemotional way, India is looking like that huge tall tower across the globe. It's a matter of time that money starts coming in. We saw some very little money in the context of world money coming in the last 2 months, and see what's happened to the market. Now, I must give credit to that Indian retail SIP investor who has been standing for this market. And that 14,000 crores going into the market has changed the structure of the market, right? So they will benefit in the long run from this growth in India. And that's what I meant by, sitting in the market will benefit. A lot of things go into selecting which is the right fund, best fund. You sit in a fund for this journey, now you see your returns.
So actually, investors have put in the faith. I had the numbers. This 15,000 crore used to be 3,000 crore in mid of 2018.
Correct.
It's very interesting to think in 4-5 years, it's gone 5x. That's a big jump. 5x in 5 years of SIP money every month. Phenomenal.
That's why when you see in giving credit, I singled out the SIP investor.
True.
I think
Sorry. I just want to re-emphasize on something you said, which I got goosebumps twice in the last 5 minutes. Once you said about the rebirth, I could feel that, yes, I know the metrics were looking gloomy pre-COVID. 2019 was not great numbers on macro front for India. And China was looking way better. Now, actually, China numbers are more cautious and India is so much more bullish. So, yes. And the second,
it's a different world.
It's a different world.
Yeah.
And second, which I will take the liberty to quote somewhere else in future also, is the analogy of cricket. We are a cricket fanatic country. If you stand at the crease, runs will come. If you bowl with discipline at the wickets, batsmen will make a mistake. That is something I will also remember, that it's a game of discipline and not a game of a T20. It's actually, if not a test match, at least play the one day. A lot of people are playing the T20 mindset, which we will discuss. Over to you, Gaurav.
Yeah, that's absolutely perfect. I would say that Rahul Dravid strategy is the best. Stay at the crease and play out the rest. So, Swarup, there's one thing I wanted to ask you, is that in last year, if you see, the markets have not given a significant return. Right? We have not even beaten the inflation, and many people had shifted to fixed income side, the fixed income area. So, anyone who's looking to enter equity market and wants to make some money, so what proportion should one look at investing in equity and fixed income, so that when equity is not performing, you can have a considerable amount of return from the fixed income side?
So Gaurav, if you ask me my personal opinion is at this moment, the investor is spoiled for choice, right? The interest rates continue to be at a higher trajectory, and then it'll take some time before it takes a U-turn from there, right? The global inflation has to really come under control, though we are seeing signs of that happening at this moment. And India is a structural growth story on the long term. So, irrespective of where you invest, it's a good time to invest. For me, when to invest is a simple question asked to me. I always answer that when you have the money is the time to invest. If you back yourself and you know where to invest, you can do it yourself. There are professionals, both as distributors, advisors, as well as fund managers, to aid you. Now, when we look at asset allocation and the virtues of both debt and equity are there in everybody's portfolio, you can add some commodities to it in the form of silver and gold if you want. I am a firm believer of international investing too. So together, all these form your asset allocation. Now, the thumb rule that we carry when it comes to risky assets versus relatively safer assets is your age. That's something which I've been practicing all my life. Your age is the safe part of your allocation. That is, say, suppose I'm 53 now, 53% is my safer part, which is debt and those kind of instruments, and minus 100 is the amount I will go into the riskier assets, which is equity, international equity, or whatever you want to form in your part of your portfolio. Now, over the years, I've graduated to becoming I won't call myself a better investor, but an investor with slightly more knowledge. So since I believe I am a slightly aggressive investor, so I add age plus 15 as my equity component. I turn it around. So for me, 60 to 70, earlier it was 60, but what's happened is, the returns, because of my core part is very large, the returns had started tapering a bit. So I took my equity component to 70 recently. But it is very mathematical. If it is 70, then it sticks to 70. At this moment, like you say, if the markets are high, my 70 would have gone to 74, 75 because of valuation. That 4% will be added in debt invariably. And thankfully for me, today, the debt is also a great time to enter at these interest rates. Even a 3-year long debt fund looks good to me. A 3-year, if the returns, the 10-year is what, 6.97, comes to 6.5, I'm looking at fairly decent returns from here on. So, but the simple point to answer your question is be very mathematical in your allocation, fix your allocations. Now, good allocation gives you good investment experience. Now, at this moment, the mid-cap run-up greed will show that, you should buy more mid-cap, but financial prudence will tell you that, stick to your asset allocation grid and buy something where your allocation is lower.
Well said, Swarup. Abhishek, you want to add something to this?
No, I just wanted to ask a bit about a trend. So you are on Twitter, and Twitter is a great place to be to see sentiments, right? If not anything. So there's a huge also interest in do-it-yourself kind of investing. So how do you see this trend? And I don't think there is any negative. Personally, I don't think there is any negative about people also doing do-it-yourself with SIP. But I think a balance is where people need to know. So do you want to say a bit about this? How should one know? Should they do it yourself versus should they give it to an expert in a mutual fund?
At the end of the day, every individual has a choice. I mean, this do it to yourself is typically asked to me on direct equity. Yeah. If somebody has the ability to back oneself and do the study, and it's a very intense study, let me tell you, the data in front of you is typically past returns. And we as mutual fund guys have absolved ourselves saying that past returns have got nothing to do with future. So we take no blame if you falter on assessing only on past returns. That's the risk. Now, if you now start building ability to understand that past return and somehow predict the future, please back yourself in doing it. But if you don't want to, and most of us, have a different life to lead, and there are professionals in the market who can help you in the process. Now, typically, when you look at investing, which scheme to buy is given most importance. While the journey of investing is a very different journey from just selecting where you want to invest. Most important part of what my distributor or advisor has done to me over the last 10, 20 years is keep me invested in the market. In times like this, when there have been some sudden returns, you have this tendency to act. While in this course of discussion, we've come to the conclusion that discipline is the only thing needed, right? My job is to put that 10,000 rupees SIP for the next 20 years. But there are enough things that will happen around me which will tell me not to. Apart from selecting what is a good scheme, the most important thing is to stay invested in this 10,000 for 30 years. That is all that is required. But it is easier said than done. So when you go to a professional, that professional not only selects a plan for you, but guides you to that plan. See, I always say, the star of an investment journey is the goal. But the rock star is somebody who guides you to that goal. If you have the ability to be the rock star, be the rock star. But if you are not and you are faltering at that time or any time, be truthful to yourself and immediately change course. The beauty of investing is all damage can be recouped. You can rechange your plan, but you have to have a good person guiding you. Both are okay as long as you play to your own strength. Now, you want to lead your own life in a certain way and let somebody guide you. There's a professional there. Why not adopt that? That's an easier way, if you ask me.
Got it. So I had two questions here. And these are my questions, actually. So I think, and these are something which I call slightly hard questions. I think the mutual fund industry has created so many schemes. At one stage, I think there'll be more schemes than the number of stocks. And as individuals, we tend to get kind of scared looking at so many options. Simplicity works for people. So with so many schemes and there's a data which says the average holding period on mutual fund came to be 2.5 to 3 years, which is not something you would also align with. You want it's a long-term product, be in the game. So question here is, how should one decide which scheme to judge? Because I'll add my thought is what majority do is they look at the best performing schemes of the last 2 years. Even though you said past returns is not a representation of future, people put in new money looking at the past schemes which perform and then invariably don't get the desired return overall. So just could you add a bit of thought on this?
See, first is something on that data that you said 2 to 3 years. Now, I gave you some data that 25 years, there were 2.23 crore folios and last 1.5 years, we've added 1.7. That data itself is skewed. Now, when you look at it overall, the last 1.5 years, the bulk of the investors have come in with less than 1 year holding already. So at this moment, with that underlying, it's a little unfair to look at that 2 year, 3 year holding, because I do believe the earlier 2.5 years, 2.3 crore, would be significantly higher than the 1.5 which have come in now. Okay. The holding period, at least from my end, I can say the Mirae data shows incredible holding. Especially if I were to give you the holding of emerging blue chip, it's at a different level altogether, right? So I firmly believe that the long-termness of the asset class called equity is being recognized and it is being practiced. Again, I will single out the SIP investor. Now, the same investor is behaving differently when it comes to the SIP and when it comes to lump sum. Lump sum, that profit booking, coming in, timing the market is still continuing. The data just shows. And the data shows what you exactly said. A little difference is that people buy last 1 year performance and sell last 2 year underperformance. My humble request is, if you are allocating, just change the allocation to reverse of it, a lot can happen. Because a lot of good funds can go through periods of underperformance because of the markets being different. For some people who are technically a little ahead of many, what used to be value stocks 2 years ago are looking like growth now. And what used to look like growth stocks are looking like value now. So all the growth managers are not performing. Value managers who had not performed for 5-6 years are suddenly top of the charts. Right? That does not make the growth stocks wrong or the value stocks bad. Now, the prudent thing to do in a portfolio is to own 2 different style of fund managers. You never know which part of the cycle you catch. These are learnings you get as you take the journey of investing, because the dynamism of the economy, the dynamism of the markets can change with the flow of money, with the results of corporates, with the flavor of the market. Many things affect the market, right? So that is what you have to learn. The market teaches you every day, and the more you learn, the better the investor you become, right? So when you come about building a portfolio, past returns have to have that much weightage. Cannot have full weightage. The flows shows that they have a slightly higher weightage, which is not correct, especially after investing or this industry being there for 27, 28 years. Things at the underlying need to change a bit.
The best example, I think, the PSU.
Yeah. Just one thought here. So we at ICICIdirect have a product which we have not marketed enough. It's a new product. It's called One Click Basket. And I was sitting with Ashish, who heads our mutual fund, and I thought it's a great product.
Yes, I'm aware of the product.
It's a research-backed curated basket of product, which lets you have the right mix, and plus also kind of takes away that bias of near-term performance and underperformance. Probably we'll put out some communication on that, but if you're listening to it, please check out One Click Basket. You'll have some great schemes coupled up there. Over to you, Gaurav.
Yeah, sort of one question is with regards to the youngsters in the market these days. So SIP is one thing, and we have our increase in SIP and the average number of SIPs. But there is a trend where in the new age, the guys who are in the millennials, 25-30 bracket, is moving towards futures and options. A lot of people moving towards futures and options. And as we speak, many people have destroyed the money, because SEBI has come out with a report that 89% of the people lose money and only 1% are able to beat the FD returns. So any message with regard to these guys who are more inclined towards future option to do 3x, 4x multiplier, and someone who's a veteran in the industry from more than 2 decades? So any message for them?
Hey, Gaurav, when we start investing, all of us are return chasers, right? And anything which shows some romance or something towards that, we tend to get attracted to that, right? It's over a period of time that we realize that it's a business of risk mitigation. And the products which we invest in, the closer they are to our risk profile, the better investment experience that we start having. Nothing wrong in starting and venturing into these products, because see, like I said, the demography of India is fairly young. And hence, and please let me also add something. They are far more knowledgeable than I was at that age, right? So it is quite natural that some of them will read it up, and the romance part of it will apply to it. And then I don't think my son is 24, and when I look at him, if he loses money, he's as ruffled as I am even now. So the risk-taking ability is very different, right? So they will back themselves and to such products, and options and futures are one part. But over the period, they will learn, and nothing wrong with it. And learning the hard way is always the best way of learning.
True.
Now, wealth creation is a very, very different sort of journey. Warren Buffett had said that very few people want to become rich slowly. But that is what this journey is. And if you're looking at some quick fix, we have a very good horse racing place in Mumbai also. Those are places which can also attract a lot of people across ages, right? Each to his own. But if you want to build serious wealth in capital markets, what is the whole thing is to identify a good promoter and then take the journey with that promoter with the belief that one day that shareholder wealth or the promoter will share a lot of his wealth with her wealth with the shareholder. When that will unfold, you do not. That is what a fund manager does. Picks up 40, 50 good such promoters and takes a journey. Now, even if 10, 20 of those unfold wealth, a lot of wealth can happen to us. And then when you look at the journey of 3.5 to 6 trillion, there is no economy in the world which is set to double from here on. That means a lot of this economy is agriculture which does not yield.
Yeah.
So there will be a lot of such corporates which will give multiple wealth or multiple, growth to their companies. And if you can just have the discipline of taking the journey with them, a lot can happen. So I am not surprised by the initial surge towards exciting products, but give them some time and don't underestimate their ability to recognize this earlier than what we guys did.
True. No, sir, I think that's a commendable answer. I felt so because there's a tendency to shy that side of the segment, but you anyways mentioned you come slightly from the aggressive. You call yourself slightly aggressive as a person. And I have been there. I have tried options. I think, by the way, we also have a series called Options Ki Baat. And we very strongly believe that every product has its merit if you do it the right way. You need to first learn the option strategies and not just do any naked calls and puts without a logic. You might do that, but learn covered everything. So we also do that on a recurring basis, that series. And so with that question, so one question also you mentioned about active and passive. Now that's an area of discussion and interesting debate even in the purist. A US market gradually moved to more of passive ETFs. In India, we are in a different cycle. We are more active and now probably increasing towards the thought of passive ETFs. So how should one think of putting money in index ETFs versus a mutual fund scheme? I know there are cost differences, everything, but since you have both the offerings, what is your message on difference and thoughts between the two?
Abhishek, as we speak today, I tweeted out that, what is your view? Do you want returns? Do you want alpha? Are they same or are they different? Now, there are different investors who want different things. Now, when you see the journey from 3.5 to 6 trillion, obviously there are returns in the market, right, in this journey. Now, when you come to an active fund, the objective is, since we charge a fee, our objective is to beat the market or give returns higher than the market. That is the alpha, right? Now, what happens in this process is, as markets become transparent, the information available becomes quite wide, and hence the price discovery starts becoming a little more difficult as we speak. Hence, the alpha opportunities start diminishing. Now, in pursuit of this alpha or this return over the benchmark or the market comes the risk of underperforming the market also. That is where the first shift happens. There will be a fair amount of investors who will say, let me just get the market return. Why will I take this underperformance risk? And hence the market, that is the indexes or the ETFs, come at a lower cost because there is no research involved in that. The cost advantage goes in favor of such products. So each investor to his or her own. If you are in the pursuit of alpha, you are in this great situation where there are enough managers in the market who can give you alpha. Yes, the number is diminishing, so selecting that manager is becoming a little tougher. Now, you don't want to take that and just enjoy the Indian ride. There are enough market cap indices, non-market cap indices. there for you. Now, one thing which Abhishek and Gaurav I'd like to point out is in the present regime of active funds, especially on the equity side, the category of funds is laid out. Okay, there are that many funds that are there, that this many categories. So the ideation of new products is limited to that extent. When you look at the passive side of the story, the beauty is wherever there is an investable universe, you can create an index.
True.
And on that index, you can create a product. And on that index, through factors, you can create n number of permutation of the products. Just for simplicity, there is Nifty 50. I will say I'll give Nifty 20. Somebody will say, okay, Mirae has given Nifty 20, let me give you Nifty 20 equal weight. Somebody will say Nifty 20 high volatile. Somebody will say Nifty 20 low volatile. I can go on. So that is what will happen on the permutation combination possibilities on the passive side. So you will see a variety of products. And here, I think I missed out answering one of your earlier questions. I am for many products. I'm not somebody who says the product should be limited. In everything that we go to buy, the basic Indian sentiment is or dikhao. Why not or dikhao here, right? Then you can have a far bigger variety to choose from. See, India typically still now is essentially a market cap investor on the equity side, large cap, mid cap, small cap. Globe does not invest in market caps. Globe has gone into structural thematic. Right? If you look at the themes in India also, they have played out. Look at our consumption, which we sat 15 years ago. See, banks for itself, banks, NBFC financials, now fintech, payments, the themes only graduate. They're not, 9 out of 10 people confuse themes to be sectors. While themes structurally grow, sectors have their nuances, right? So as we graduate as investors, we should have enough products on the satellite side, which can start giving the kicker. And that's where, on the present structure of mutual fund industry, the passive have the edge of giving some incredible products. Make no mistake on that. So my view is very simple. The investor is now more educated. The avenues of investing are far superior. The tech play is there. The ease of investing is there in front of you. You can go from an individual to a trader in 10, 15 minutes. Earlier, it used to take days. So you cannot take away these things in getting more and more investors into the market. What they will choose, time will tell. But there is a place for all products and there is a merit for all products. So as long as the investors assess them on their merits of their portfolio requirement, we are in a position where all products can thrive simultaneously, is my personal opinion.
Absolutely. I think, sir, you have covered almost everything. But before we close this, we wanted to know you as a person. So what are your hobbies outside market? Because we have spoken a lot about markets. So we've known that you are fond of music. So you can just put some light on that outside market, Mr. Swaroop Mohanty.
See, music is my family, listening to music. My father, very early on, he's a teacher, so you have to listen to a teacher, no? Said studies plus one. So for me, earlier on, studies plus one was that cricket. I did play cricket for some time. But then slowly, listening to music was a constant. I firmly believe music is my therapist. And when I go home, that's what I do bulk. I'm an addict of OTT also. That's kept me sane because sometimes the market can really wreck your brains.
Sir, any OTT recommendation for the audience? It will be interesting getting OTT recommendation from a fund manager.
I think I just finished watching Scoop, which I really like.
I've seen,
watch a lot of true stories. Okay. I think Scoop really went down well with me. I just finished a Korean serial called The Glory. Not because I'm from a Korean background. I like the way they approach The Glory also. I just finished. But most of them I like is as period sagas. My favorite would remain the Medici, which is phenomenal. I think The Kingdom is something which I'll recommend. So सबका अपना अपना होता है. So I like period dramas and true stories. So I can go on OTT. Okay, don't question me on that. This can be a 2-hour session. But a lot of it is music. I listen to music on the analog form, which is the old vinyl records. They are new also. So I'm a third generation vinyl listener. And sometimes, we can do a session on my vinyl collection. It's a pride of mine. And that's
we
where
that would come down to your place and do
yeah, be my guest. That's where I'll really show it off. Okay, I've invested very heavily on my system, and that's where most of my money goes. People find it weird, but that's my life, and that's what I do. But travel takes up a lot of my life, meeting new people, new cultures. I just did Japan, just blown away by the culture of that country, by the beauty of that country, the discipline of that country, and the simplicity of that country. I came back a different person. My other investment is travel, so I've benefited a lot from meeting people across the world.
Absolutely. So thank you so much, Swaroop, for being a part of this. So viewers, this was Swaroop Mohanty, the CEO and director at Mirae Assets. You can check out their products by going on their website. There are many more products there. And also on ICICI Direct, we also host a lot of products of Mirae. So thank you so much, sir.
No, thank you so much for having me. It was such a pleasure.
Thank you, sir. I thought it was a great conversation. Learned a lot. And viewers will drop the link to Swaroop sir's social handles. Please follow him. Probably I'll request, sir, please share more OTT recommendations for the audience on your Twitter, if that is one takeaway.
I will do so.
Great. So it was a wonderful conversation, sir. Thank you so much.
Thank you.
Please note, mutual fund investments are subject to market risk. Read all scheme-related documents carefully.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.